This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. Today, we're very pleased to welcome on John De Goey, portfolio manager with Design Securities. And we're going to be talking about a lot of interesting stuff. It's not too terribly often that we get people that bleed over from the traditional side of finance, stocks, bonds, securities markets into the alternative space. But that's why we're very excited to talk to John today, because he kind of bridges that gap with his look on finance. We're going to be talking about kind of how to look at your financial advisor with regard to what services they're providing to you. If maybe they're getting some blinders on, or maybe being a little bit too core focused on some things that aren't offering you enough of a breadth of options to really offer you true diversity within your portfolios. And I'm sure we'll get into some other great topics as well. John, thank you very much for being on with us today. If you wouldn't mind, give us our listeners a little bit of background about yourself and kind of how you came to currently be a portfolio manager with your current firm.
So I joined the industry in 1993, Alex. So I'm just that much older. You can see how gray my hair is, that I've been around the block a few times. I joined the industry in 1993. I got my various designations, my CFP, my investment manager designation, what have you, within the first year or so, and have proceeded to build up a roster of clients over the years. In the aftermath of the global financial crisis of 2007 to 2009, I realized that even though I was, I think, reasonably happy with my role as a behavior modifier, as a person who could actually coach people to make better wealth decisions, which, by the way, is the name of my podcast, it didn't work as well as I thought it would, because I couldn't get people to rebalance after 2009, when stocks were down and bonds were more or less flat. And I realized that what I needed to do is I needed to become a portfolio manager, because I needed to be able to do that myself on an ethical basis, acting as a fiduciary for my clients. So I became a portfolio manager in 2009. And that way I didn't have to worry about people not necessarily doing what I recommend they do, which is to, buy low and sell high and rebalance based on a target asset mix. I could just do it on their behalf without having to get them to possibly hum and haw after we had a pre-commitment to do these things. So that's what led me to be a portfolio manager. Here we are now. Also, along the way, I've written 3 books. One of them, Stand Up to the Financial Services Industry, is there over my shoulder, but I've also written one called The Professional Financial Advisor, trying to get advisors to be more professional, the way doctors, dentists, lawyers, accountants are professional. And then most recently, I wrote a book called Bullshift, with an F, Bullshift, about how the financial services industry shifts your attention to make you feel more bullish. It's basically about how optimism bias is a threat to your finance. And that's part of why I've become a proponent of alternatives in a way that I perhaps hadn't been previously, because I think there's a lot of optimism bias in the industry, and a lot of investors might not be fully aware of how much risk they're taking when they use conventional portfolios.
Sure, that's some really interesting things to kind of look at here. One thing that I would like to maybe, at least draw on your experiences, because, for no particularly bad reason, let's say, a lot of the people I have on my podcast are, typically younger, typically my peers, between the ages of, let's say, 35 to 45. And while that's certainly a good thing, or maybe a neutral thing, if you will, it bears a lacking of really boots on the ground experience when it comes to going through very large market shifts, right? So, I came into my career in finance in the end of 2011, and things were, rocky, but they were on a, kind of a general upward trajectory. But,
Sure.
people that haven't gone through things like, the first recession in the beginning of the 90s, kind of when you came into your professional career, or had, really been boots on the ground professionals during the global financial crisis of the early aughts. It's really interesting to get the perspective of some corollaries that you might draw now from, what people were, afraid of when it came to the rebalancing, and what you might see now that might be some kind of of cogent points to draw out because, a lot of us right now have been kind of enjoying this, with the exception of maybe, March to August of 2020, haven't really seen anything that was very sticky as far as a shift in the markets. If anything, that point in time did great things for my portfolio personally. I was, right in the beginning of COVID, I pretty much sold everything off and maybe I got a little bit late in the dip, but I mean, for all intents and purposes, I mean, personally made out well for it. I know, most people, just given the trajectory of pre-COVID to after COVID, if you did nothing, you did well, in the securities market. So now with a little bit more of, things that are pointing towards maybe a bigger, more sticky shift, what are some things that you kind of learned from the GFC and going through it, and what people can take away from it now with regard to potential rebalancing and some high level points to take away from that?
Sure. I would also point out that there was a bit of a drawdown from January till August of 2022 when we had these rate hikes that were dealing with the normalization of interest rates after and inflation coming on board. So there are two things that I have experienced that perhaps you and others of your generation might not have experienced. The first would be the dot-com bubble at the turn of the millennium, and then the second would be the global financial crisis. And I think as the old saying goes, history doesn't repeat itself, but it rhymes. And there are similarities with regard to how human behavior being what it is, people just reacted the way you would expect them intuitively to react, which is they become fearful. So the first thing that I would say is that people will tell you 5 ways till Friday that they understand the principles, that this is a long-term perspective, and that's especially true for your demographic. My clients are older, and therefore they don't have as much time and can't buy the dips because many of them are already retired. But if you're working and you say that you take a long-term perspective, then you should be able to have the courage, to summon the courage to say this is a great opportunity. Stocks are on sale because they're down by 20, 30, 40%. And I should be, backing up the truck and investing as much as I can to do so. Despite that, human nature being what it is, a lot of people simply don't have the fortitude to do it, even though they tell you beforehand that they do. Even if you get it in writing, even if you have an investment policy statement, even if their KYC obligations are such that they say, I'm a long-term investor, I have a high risk tolerance, whatever they tell you beforehand, oftentimes, if it doesn't go out the window, it is at least compromised and watered down for many people when it happens. And so the question then becomes one of, well, what will you do as the person giving advice to these people to help them as you try to help them get to their retirement goals? And a lot of that involves if you can preemptively put them into investments that would get them comparable returns, but with less volatility and with less correlation, which is to say it's not all going down at the same time, there's a greater likelihood you'll be able to get them to stick with their pre-agreed plan, their pre-agreed program and discipline. A lot of investing is not about number crunching, it's about focus and discipline. And a lot of people will claim to have it until the circumstances change and then suddenly they don't.
And really kind of, why do you think that a lot of people are wrong about their risk tolerance? Is it just a general kind of misunderstanding of really, their own internal metrics of what they're looking for? But really, do you have like kind of an idea of why that might be?
Sure. It's all of the above. It's not really it's first off, there aren't a lot of really good psychometric questionnaires. The questionnaires that the financial services industry uses to quantify risk tolerance are oftentimes not academically rigorous, and they don't necessarily um, track well with the actual tolerance or capacity for the investor. So that's number one. We don't even know ourselves. Number two, I would say there's a problem of what's called present bias. So a lot of people, when they make decisions, they say they're taking a holistic long-term view, but when things are right in front of them and they're looking at their portfolio dropping day to day, week to week, they cannot help but think about what that does to them emotionally in the here and now, and that sort of short circuits their thinking, and causes them to deviate from what they insisted they would never deviate from. So those are a couple of things that I would say. As I've written about it again in Bullshift, optimism bias is a real problem. So optimism bias is this notion that um, people acknowledge that bad things will happen, but for whatever reason, they don't think they're going to happen to them personally. So it's like, yeah, people are in car crashes, but I'm not going to be in a car crash. People get divorced, but I'm not going to get divorced, as if they're somehow special because they are who they are. The fact of the matter is, there's no way of knowing in advance. It happens. These are the sorts of things that happen quite randomly, and there's no reliable predictor. And you should expect that bad things will happen to you at some point, and you should be prepared to endure that. Most people don't seem to think in those terms because they optimistically believe that for whatever reason they think they're immune.
Exactly, and it's hard to kind of take that really thorough introspective look, especially if you're outside of the finance industry, right? It's a lot easier for people in our positions to kind of look back, and one tool that I like to use, and I've told some of my friends as well, is that if you're concerned about what's going on, there's plenty of tools on the on online where you can go back and set price points for buying and selling different securities or different things on the stock market in a certain time date window. So you can see how something would have performed. It's good to adjust for inflation with your capital investment now back to, when you were purchasing something, and see over, let's say a 2-year period, what something would have done if you had held, buy or sold, let's say through the great financial crisis or the global financial crisis or through the early 90s or through the savings and loan. If you're trying to find an analog for what's going on in the current markets, that takes a lot of, kind of, again, just willingness to do that, to see that, and then also to digest it and say, okay, here's how I can use that, kind of primer of history to, again, like you said, history doesn't repeat itself, but it rhymes. I might steal that one.
Yeah.
But again, to look at that, and, the tools are out there for people, to kind of help this. But at the end of the day, you have to understand, knowing your mindset and also, understanding, things about the psychological aspect of your money, things like, again, like you said, like present bias of what's going on and not wanting to lose in the short term. Everyone wants to have that $3 million nest egg when they retire, but it takes some work and some willingness to weather the storms, if you will, going through that. So that's kind of again an example of what I do to help me, at least with my more traditional portfolio and looking at it, and it's worked well enough. I would say that I'm happy with my performances. I haven't, beat the market by any imaginable stretch, but I've done well enough to where I'm, not beating myself up over most decisions I've made.
Yeah,
But
and a lot
yeah,
of what you should be thinking about is are you reaching your retirement goals rather than benchmarking yourself against the S&P 500 or whatever else. Think about, well, where do I want to be when I'm 65? And if you're on track to meet your goals, provided those goals are in fact realistic, then beating the market along the way is really not part of what is even part of what the game is. It's about focusing on your life and meeting your objectives for your reasons and your on your terms while still enjoying your life along the way.
absolutely. And I think that people kind of miss that. It's like, it's great to look at, retirement. It's like, hey, I no longer have to work, but do you want to enjoy your life along the way? Stop and smell the roses occasionally. Which kind of leads me into my next question for you is, it's easy enough for me to say because I do this from, I wish it was 9 to 5. It's, my career has been staked in finance for better or for worse, and I deal with this every day and I look at it from a certain lens. But for people that are coming from an outside perspective, if someone works as an engineer or medical field or as a cashier at Walmart, it's tougher for them to kind of look at it just because they're not doing it day to day. So how can people kind of effectively assess these kind of factors to make better decisions on their investments? What are some tools that people could use for that?
So again, ironically, I talk about making better wealth decisions. So as you say, there are a number of tools online. I can't think of any online like websites off the top of my head, but there are things that you can do. There are financial calculators that can help you understand what kind of return you want, what kind of expectations you should be setting. I think one of the problems that a lot of people have is they think, oh, well, I can reach my goals. All I have to do is get this 11% rate of return or what have you. It's like, well, no, actually, most people, the way you reach your goals is to save more and assume a lower rate of return because most people left to their own devices will assume a return that is higher than it ought to be. So in terms of tools, I would say go online and actually look for tools because everyone's different. Some people have to pay down their debts. Some people have to save for an education for their children. Most people are in some capacity saving for retirement. Some people have more complex situations where they probably need an advisor to help them, set up a holding company and do what they can to arrange their estate and minimize their taxes. But whatever it is that you have, there are tools available online provided that you, in fact, have enough interest and capacity, because not everyone, some people it's just beyond them. And that's when you probably need an advisor to help you. There are lots of people, however, who are young, who, if they have a plain vanilla situation, could go to an online so-called robo-advisor and at least have someone give them some guidance in making decisions. So there's a whole continuum of how much help do you want, how much work do you want to put in yourself to make sure that you're making decisions. But I think the most important thing is the decisions you make need to be made from a place of um, self-awareness and focus and discipline, so that you don't go around and change your decision and justify it after the fact because the circumstances changed. A good decision, a good financial strategy is a lot like a compass rather than a map. And a compass points you in a general direction, whereas a map tells you where to turn and how far to go and what you're going to encounter. A compass says, this is the direction I'm going in. I don't know what I'm going to encounter, but I know that if I go in this general direction, I'm going to get to where I need to go.
No, absolutely. And part of what you're saying is that, having that plan, at least seeking out help. I think that's kind of a lot of the things that, especially in my generation, not as much, but I feel like with the younger generation, the kind of with all the generations now, our colleagues, we use
Right.
the terminology for them. I think it's I'm a millennial, so there would be the Gen Zers and then the Gen Alphas, are so used to just getting everything consumed, not necessarily from someone with a pulse, right? Don't be afraid of reaching out. People have doctors. Everyone goes on WebMD and they think a toothache is that their head's going to pop off, but going in and don't be afraid to talk to someone. We are financial professionals. There's a reason that we've done this. We enjoy
Right.
helping people make these and achieve these goals, whatever they may be, whether it's on the advisory side or the alternative asset space that I work in. You know, a lot of people, I think, in today's society, at least in the cultural shift, are a lot more afraid to kind of pick up the phone and call someone or sit down in someone's office. You can get a lot of value for that. If that's not you, that's fine. But at least reaching out to get the information. Don't
Yeah.
just read the article. Get something that has some type of interaction with it, where you can pose a question and get an answer. Maybe AI isn't quite there yet. For ChatGPT just to spit out advice, if you will. But again, don't be afraid to reach out, whether that's to a person like John or myself, or to some type of service that you can get some outside perspective. Because then you get those little the kind of the blinders on, and that's what and bad things can't happen. Now, for let's say for people that have engaged a financial professional, let's kind of dive into what people can be doing to make sure that things are again kind of on track for what your goals actually are. So, maybe if you can kind of go into a little bit of seeing how to test your financial advisor from some of those blind spots, because that'd be something I'm kind of interested in hearing your perspective on.
Okay, so again, ironically, my book Stand Up has I'm going to say maybe 3 dozen questions that you could ask your advisor. So this is to my mind, a three-part problem. Number one, you've already touched on the first. A lot of people put their head in the sand and they don't really have the courage to ask questions. So first thing you need to do is you need to summon the courage to hold whatever person you're working with accountable for the advice you're being given. The second thing you need to do is you need to be able to ask intelligent questions. You need to know what questions to ask, because a lot of people, the reason they don't ask the questions is because they don't know what questions to ask. So stand up actually gives you the questions. But then here's the real problem in my mind. Most people, even if you spoon feed them a laundry list of questions and have them march into an advisor's office to ask the questions, they won't be able to discern a reputable answer, an evidence-based answer from a line, a narrative that is just a sales pitch. So one of the things I do in stand-up is I actually say, these are the sorts of answers you should be looking for, and here are the sources. So you know that I'm not blowing smoke. Here's the evidence in terms of what you should be expecting in terms of the research. a lot of people, and I would say, unfortunately, a lot of financial advisors are oblivious to some of the best financial research. And that's a real problem that's insidious that I don't know that I have an easy answer because when the people that are giving the advice are themselves unaware of the possible blind spots that they have, then you're not any further off than being a person who's making decisions on their own. And even if you're aware as a decision maker that you have blind spots, all you're doing is you're paying a fee to exchange your ignorance for the other person's bias or blind spots. And you're not necessarily going to be any further ahead. So try very hard. There's no easy answer, but try very hard to do reputable due diligence so that you can satisfy yourself that the person you're dealing with, that you're taking advice from, in fact knows what he or she is talking about. Look for designations, look for experience, Yelp reviews, referrals from other clients, other friends that are there that are working with this person who can say, yes, this person actually is proactive, focuses on my needs, thinks about my circumstance and doesn't just offer generic advice, those sorts of things, because those are good markers for getting advice that will be helpful and hopefully customized to yourself and your circumstances.
Yeah, and one thing at least personally I like to add to that is, understand how someone is talking to you. If you ask a question about a certain asset class or a certain thing, granted it may not be a fit for you, but the way that someone talks to you when something maybe isn't a fit can kind of speak volumes. Certainly there are few people that are very apt to be invested in things like forex, right? It's very volatile. It's not something that a lot of people should do. But if you ask an advisor, say, "Hey, what about this?" and they're like, "Oh, that's the worst thing ever," and they start, denigrating your question, it says, "Hey, look, here's maybe this is probably not the fit for you. It's extremely risky. You need to do a lot of research. You need to kind of be, a professional in the space to really possibly even do well. And even then, there are big inherent risks. The kind of way that people address things that maybe outside the scope of what they do. And a big thing, especially what we do with alternative investments, I hear a lot of, clients say, "Hey, I talked to my broker at XYZ wire firm, big house. And they said that, oh, this is horrible. This is awful. You're going to lose all your money." And the investment might just simply be investing in as a limited partner in an apartment complex with a operator that's been doing it for 30 years. Again,
Right.
that may not be suitable for them. And that may very well be the case. But again, it's not something that, should necessarily be, again, denigrated just because they don't like it and it gets assets away from their administration. Look for someone that's going to give you real answers in a, I hate to say just the easy term, polite way. But again, not
Right.
everything's for everyone. But, if they're going to come out and just, salt the earth on a legitimate question and you're trying to get, exposed to more things like, no, what I'm doing is the best way to do it, that again is something that personally that I feel is a good example. And I've had certainly clients that, their advisor came back and maybe they didn't do a deal that through our service because the advisor said, "Hey, look, here's really what you're looking at." And a good example was I had a client that was nearing retirement. The investment, again, in my thoughts, wasn't necessarily bad. Again, I'm not a financial advisor. I couldn't say that specifically for them. But the issue is that they didn't necessarily realize that the investment had like a 5-year lockup. They would be illiquid for that time. There'd be cash flows, but they didn't realize, hey, my needs for capital, this is going to draw it down so much that I'd have to liquidate or rebalance some other stuff. And I really appreciated the way that he approached it. Again, would have loved to have them as a client, but at the end of the day, I would prefer that they are in a better financial situation than just one more client, a little bit more AUM for us. So those are the kind of things that I really enjoy seeing in the financial space. And to kind of piggyback on what you're saying, of asking questions, but also listen to how these people are talking to you. You want to be talked to like a person, not just like a number, right? So that's kind of my 2 cents on that segment of kind of testing your financial advisor.
What I would say, Alex, is there are relatively few products that are truly awful, but there are many, many, many products that are not suitable, no matter who you are, because different people, it's different strokes for different folks. It's not like there's a definitive right or wrong, but there is a much more narrow, suitable and unsuitable range of things. And as long as people understand what it is they're purchasing and why they're purchasing it. So again, what are the concerns with regard to cost? What are the concerns with regard to a sector, liquidity or illiquidity, whatever correlation, whatever it is that whatever it is you're buying, it's oftentimes not necessarily wrong, but it might not be suitable for you. So as long as you understand what it is that you're buying, I'm not as worried. The problem is a lot of people don't understand what they're buying. And then that's when you get into problems. Is, something goes wrong and they go, well, I didn't know that this was locked up for X number of years and I need the money now because my car broke down and I need a new car, and this is in my non-registered account, and I was relying on being able to liquidate this in order to get a new car or to get the old car fixed or what have you, and now I can't. Well, that's the sort of thing that's a bit of an extreme example, but it's an example of things that you absolutely positively should have known and taken into account before you purchased the product in the first place.
Exactly, and that's a big thing that I try to do with this podcast, and we on the professional side of Advanta really try to aim to do is educate people. We do not to plug too much, but all of our education isn't gate kept. We over 1,000 videos on YouTube, almost 200 episodes of this podcast, blog articles, white papers. An educated investor compared to an uneducated investor will probably be, again, a more successful investor. Just understanding and having the education. And the other point to that is also understanding where your education comes from. Understand, no one just kind of does anything completely altruistically. Granted, there is a degree of altruism of what we do, but at the end of the day, we got to keep the lights on. Understand what the incentive is for the person educating you on something. Do they have a bias in saying, hey, something is incredibly great? Understand where the biases lie in the education you get, and also, again, that's, I think, kind of a core of what you talk about is some, biases, whether that's internal, whether that is, external from people giving it to you. Understand, why the flavor of the ice cream that you're consuming is the flavor of the ice cream you're consuming at the end of the day. Is definitely something I think is key in that I try to at least to educate people on. And again, just get out there and consume knowledge. It's, typically won't be a bad thing.
Earlier in 2024, one of my heroes, Daniel Kahneman, passed away. And Kahneman was the author of a book in, I think, 2010, 2011 called Thinking Fast and Slow. It was a New York Times bestseller. He was the Nobel laureate in 2002. And it's interesting because he is seen as the father of behavioral economics. And he and his research partner, Amos Tversky, did a lot of work with regard to prospect theory. It's probably their most useful insight, and that's basically based on risk aversion and how people feel the pain of a loss twice as acutely as the joy of a gain. And when things look as though they may be bad, they actually become risk-seeking, depending on how the situation is framed to them. All of which is to say, you need to know yourself. And one of the things that I'm just actually rereading Thinking Fast and Slow, sort of in honor of Danny, because I think it's such an important book. But one of the things that he says is that everyone, absolutely everyone on the planet has biases. He himself, probably the person who has done more to uncover biases, and he uncovers them precisely because he was so inquisitive about, why did you do that? And so he, and he would ask other people and say, well, that's not what I would have intuitively expected, and yet you did this. So you can do research to actually find that pretty much everyone has biases. So it's not, you cannot eliminate them. The best you can do is be as aware of them as possible and take steps to manage them. So one of the things that you said earlier in the podcast, Alex, was how you would sometimes write things down and go back a number of months later to see how what you wrote down did. So that's called a pre-commitment if you're thinking about decision making. So a great way to test your own biases is if you think something is a great thing to buy, or if you sell something because you absolutely think that it's at the top, before you buy it, before you sell it, or when you're thinking of buying or selling, journal it. Write down, I was going to buy X, Y, Z, this security at this point in time on this date at this price for this reason, and then go back and check 6 or 12 or whatever months later and see if your thesis played out. And I can tell you that the people that I speak with that do it find it very humbling because there are so many things that we just cannot reliably predict, and we need to understand that you can have a good thesis. And I'm not suggesting that none of them are going to work out. Some of them work out. Some of them work out better than you thought. But a lot of the time, what we think is obvious and self-evident it doesn't play out the way we expected, and for reasons we didn't anticipate, and oftentimes because the reason that things didn't work out was something that wasn't even on our radar when we made our original assessment, because we can only know so much. And then you start getting into your filters and what's your source of information, how reliable is it, how robust is it, what are your blind spots, and what did you do to build a portfolio and to make decisions that take into account that there are things that you just don't know. We talked earlier about how history doesn't repeat, but it rhymes. One of my other favorite sayings is the difference between theory and practice is that in theory there is no difference, but in practice there is. So if you want to test what you're doing, do it in practice. And if you don't want to lose money because that's an expensive way of testing a hypothesis, write it down. And this is what I would have done. If it was up to me, I'd have put $10,000 into ABC securities in September, and then go back in September of 2025 and see how that $10,000 would have done, and just test yourself to see and see why you would have done it. I'm doing this because I think the growth thesis is such that it's going to open new markets, and revenues are going to explode, and as a result the PE is too low or whatever. You write it down and then you check to see if your rationale is in fact what happens.
Yeah, and I also would also say to that, if you're doing that personally, also ask for the rationale of your financial advisor as well. Say, hey, look, this is all well and good, but why did you do what you did? What is your thesis? How are you kind of tracking this to make decisions for me? And again, that answer may vary, but it also could be kind of a primer for, understanding how, effective or how much work they're putting into it for you as well. If they have 500 clients and it's just some rank and file person at, pick any one of the big advisors, do you maybe want to go to someone a little bit more local? There's plenty of small, there's a whole cottage industry of the individual financial advisor that hasn't gone away. It's shrunk. It used to be, that was kind of how it worked. You had your local, office of this right on the corner, right next to, on Main Street, if you will. And, it has dwindled, but just kind of like, vinyl records are, oddly enough stuck around and surpassed CDs. It's still coming back and people still find a value to that. The warmth and the reproduction of a vinyl record, again, from the kind of the sterility of CDs, is kind of a great way to look at it. You kind of have this big sterile industry of, highly analyzed stuff where they've taken the human component out of it. But again, reach out and ask if you don't think that you're getting the focus that you need, and there are people locally to you that can help you with that.
I was going to say, Alex, for your demographic, a lot of people are more comfortable doing things online, doing things on Zoom, and just changing emails and whatnot. But given that I'm about a generation older than you, I can tell you that what you just said resonates. A lot of my clients don't even like Zoom, so they would actually rather prefer the telephone, which is still not as good as in person. But in the post-COVID world, in person is a lot less of the way things are done, and so now we're finding new ways of doing things. But a lot of people that are, to my experience, that are senior, that grew up with the telephone, that did not grow up with Zoom, are more comfortable with just talking on the phone. Ironically, but the other thing is that you've got to meet people where they are. And if people are comfortable with one medium of exchange, then that's what you have to do, is to help them feel comfortable no matter what it is that they feel most comfortable with. You've got to be adaptable as the advisor to speak their language and to speak to them on their terms so that they have a comfort level, because part of their taking your advice is being comfortable with who you are and how they work with you.
No, absolutely. And to kind of, go into the last point that we had kind of delineated before this call, some of the vices that kind of keep people repeating these bad decisions that they've made. You kind of mentioned, that were five of them, and I don't even know what they are. So I'm kind of interested to, learn more about some of the things that keep people in some of these bad cycles of, just like, again, not asking questions, not getting the performance
Sure.
that they need for their goals. What are some of those vices that you feel are prevalent that people need to know about?
There are dozens. I'll see if I can come up with five off the top of my head. But so let's begin with something called hindsight bias. Hindsight bias is when you look at something after something goes right or goes wrong, and you say, "Oh, Yeah, I saw that. But in fact, if you going back to the journaling that we talked about a couple of times already, the fact of the matter is you didn't see it coming. You developed a narrative that caused you to say, "Oh yeah, you saw it," but the fact of the matter is you didn't. You're not as clairvoyant as you thought you were. So that's one. We've already talked about optimism bias. We've already talked about present bias. There's a sunk cost fallacy that a lot of people worry about. So that's where, or don't worry about, or don't think about. But the example that Richard Thaler, also a Nobel Prize winner, uses is, let's say you've got concert tickets to see one of your favorite artists. You paid $200 of tickets, and you and your spouse are going to see your favorite artist. But it's an outdoor concert, and it's raining cats and dogs. Uh, do you do you still go to the concert? As compared to you want to get last minute tickets, and it's your favorite, and you happen to find yourself in town, and you weren't planning on going to the concert, but now you're in town for your favorite artist. There's still a couple of tickets available, also at $200. Do you buy the tickets? Given that you know it's going to be that the show is going to be raining cats and dogs, and people make different decisions. Basically, if they've already bought the tickets, they'll say, well, maybe I'll go because I've already paid for them, so I guess I have to go. But if they haven't bought the tickets yet, they'll just say, sort of like sour grapes. I didn't really want to go that badly anyway, and then they don't buy. Well, it's the same concert for the same $200, and your decision should be the same either way. But of course, if you've already prepaid, it has an impact on the decision you make, and that's one of those things where human beings think of themselves as being rational decision makers that make decisions that are consistent based on their own self-interest. In fact, they make a lot of decisions that are justified after the fact. So those are some examples of the sorts of biases that we all have. And it's if you read a book or two about behavioral economics, or even just go online, just go to Wikipedia and read about behavioral economics, you'll find that there are just dozens of funky things that we humans do. It's like there's a whole library of TED Talks on the subject if you want to learn more about how we make decisions that we think are rational, but they predictably are not. So in fact, there's a guy by the name of Dan Ariely, who's a prophet Duke, who I was thinking of, who I've met and who's given some TED Talks, and he's written a number of books about this. One of them is actually called Predictably Irrational, which is to say there's a small mountain of research that shows that the traditional economic theory says this is what you will do as a rational, self-interested actor with this circumstance, and yet repeatedly, predictably, we know this, we do something different when the circumstance presents itself that causes us to go off course. So we do things that are not only irrational, but they're predictably irrational. We ought to see it coming, we ought to know better, but we make the same mistakes anyway.
Yeah, it's always a tough one, especially when you again too, and I wish I was maybe as self-aware and analytical about other activities in my life,
Yep.
as I am about my financial world. Otherwise, my waistline might be a few inches smaller, and who knows. But it's one of those things where again, it harkens back to again the sunk cost fallacy is definitely a very good one to bring up, of just that inherent. Disallowing of admitting failure when you otherwise shouldn't, especially in finance. It's like, should I sell this dog of a security? Well, no, like I'd like something. I already bought it. It's like, no, it's like there needs to be a stop loss. There needs to be um, a trailing limit order to basically everything in your life, right? You need to have that kind of bounding, sell order for anything that you do, whether that's, picking up a cheeseburger or, selling that stock that you keep wanting to sell, but you're like, you know what? I've lost so much money. Let's, it's going to come back. Just, understand where you need to cut your losses.
So that actually brings up another concept called the escalation of commitment. So a lot of people, this is just human nature, double down when they have two securities in a portfolio and one's going up and one's going down. They repeatedly sell the winner because they say it's not a loss unless you sell when it's down. So a lot of people will sell their winners and take a profit and say, ha ha ha, do a little dance because I won because I bought it at X and sold at 1.25x or what have you. Great, but meanwhile you also bought this other security at X and that's now trading at 0.75x, but they don't want to sell because so what you're doing is you're compounding and magnifying your losses by being unwilling to realize those losses, because that involves the psychological pain of admitting that you bought something that went down when you had this whiz bang thesis that you may have even written down 6 months ago that you said this would never happen. And people just don't want to. It's too painful to admit they made a mistake. So people would rather do something which is suboptimal than admit the mistake.
Yeah, chasing bad money with good money.
Yeah.
It's a tough one. And where I'd like to kind of, again to talk about, kind of what we've, looked at has been kind of again very focused on, the major traded securities market of things that, people are again very exposed to. And one of the things I was excited when we initially got connected was that, being in the financial advisory space, again, kind of going back to a lot of the bias that the more traditional markets has against what we do in the alternative space, was to actually talk to someone that is not averse to it. Again, it's not for everyone, but at least there's few and far between people that operate primarily in the traditional securities markets that have a at least an eye for, or at least anything positive to say about the alternative space. Whether that's for ignorance of not understanding it, or just, some kind of, again, bias that they have towards it. So, maybe I'd like to understand a little bit about what your thoughts are on, maybe some of those biases and some of the things that you like about it from the, broad perspective of what,
Sure.
things that just aren't on a securities market can offer the broad investor basis.
Sure. I've talked a fair bit about biases already, so let me see if I can come at this from a slightly different perspective. The first thing I want to say is that in 2024, 2025, we're now at a point where the world has come to realize that alternatives are here to stay and they're becoming increasingly mainstream. If you think of what all the best pension plans and endowments do, they pretty much all have a significant exposure to alternatives. If you think of the so-called Yale model, and David Swensen over at Yale was perhaps the pioneer of this, uh, we could have portfolios that are more than 50% alternatives, and I think that's probably a bit much for most retail investors. But I think 0% is also ridiculously too low. There should be some number, and again, everyone's different, but you should not disqualify the possibility of using alternatives just because they haven't been used in the past. So one of the things that Swensen has shown, if you look at what the best research shows, there's this guy named Harry Markowitz who wrote a PhD thesis in 1952 talking about what is now known as modern portfolio theory, where you have this concept of an efficient frontier, where you try to get the best return for a given level of risk, and you try to maximize your risk-adjusted returns and move your portfolio upward to the left, so you're getting higher returns while simultaneously lowering your risk. Using alternatives pretty much always extends the efficient frontier, which is to say, if you have a traditional 60-40 or 50 or 70-30 portfolio using just traditional stocks and bonds, the risk return profile will be one thing. But if you judiciously add some alternatives that will get you good returns, not necessarily fantastic returns, but not bad, but oftentimes with less variability and with less correlation, so that they will zig when the stocks and bonds zag, so that there's less ups and downs on a quarter to quarter basis, which of course is also good from a stick to your plan perspective that we've talked about a couple of times already. Not only will it help you to modify your behavior to stick to the plan, because the best portfolio is one you can stick with, it will also ultimately, if done properly and you actually stick to it, get you either a higher return or lower volatility for the same return, or depending on how you mix and match, maybe even a bit of both.
Yeah, and one thing that I always encourage people to look at is, what are the sources of either revenue or growth within a portfolio? Within the stock market, they're all kind of based on the same thing. Dividend is going to be based on share price. Capital gain distributions are also going to be based on fund performance as a direct corollary to underlying price of what you actually own when it comes to hedge funds. But you can get exposure to different types of either cash flow or growth models when it comes to alternative assets. And again, those may or may not be suitable for you. And that's definitely something to talk to your financial advisor about. But one easy example, and it always rubs me a little bit that, real estate is considered a alternative asset. heck, the Romans were conquering and, acquiring real estate. They didn't have a
Right,
stock market. That didn't come around till like the 1600s in the Netherlands, right? So
right.
you have a good basis on this being a viable asset, but the ability to invest relatively price point agnostic if you're looking for cash flow. Your rents aren't going to directly go up and down with the price of the underlying asset. If something rents for $2,000 a month and you bought it for X and it goes down by 25%, well, you have a contractual obligation for that to still be rented at a certain price. And it's not going to fall, but it typically will rise commensurately with value. So again, those are much more longer term investments. They're not very liquid. They can produce great cash flow, but if you need a large liquidity event, you can't just go and click sell on
Right.
a brokerage platform. So again, suitability again is key for this, but understanding what alternatives might offer you, again, doing proper research, making sure you're investing in something that is suitable for you. People just don't realize the different types of things it can offer. It's not always just, hey, buy low, sell high, which again should be a good principle for, almost every investor. You want to make money.
Right.
We're not in here to just, say, hey, I lost everything. I'm a great investor. It's just understanding what these things might offer, and also having someone that can advise you on saying, hey, is this a suitable investment for you? Is kind of where it's frustrating from my perspective, my industry, to find those people kind of in your position that can guide people with some cogent thoughts on that.
Yeah. I think when you think about portfolio construction, if you look at it, someone gives you a blank piece of paper and says, well, what would you want? Well, you'd say, I want to be able to build a portfolio that is diversified within and throughout asset classes that helps me to reach my goals on an absolute basis with a risk tolerance that I can handle, taking into account possible behavior, all manner of possible market conditions and outcomes and circumstances, and of course accounting for my taxes and accounting for my income and so forth, and then try to build a portfolio. Now, if you think of that, my point that I made 5 minutes ago continues to hold. The portfolio that you could build if you just use traditional stocks and bonds would get you a long way and would be quite good, and it's been fine for most people for many generations. But now this generation is the first generation that can build a superior portfolio by adding alternatives to get you to a better point where you actually have either a higher return or a lower risk or a bit of both as a direct result of including alternatives as part of that portfolio design and construction process.
Yeah, and you mentioned taxes briefly, but I always like to say, hey, come to the alternative side. You want good tax breaks? Look at some of the stuff that you can pass through with the alternative side of things, that you don't get nearly the exposure to in the more traditional markets. There's some pretty cool stuff that you can do with it. But again, maybe that's not even a concern of the individual client. That's, again, I always kind of harken back to this because when I try to illustrate benefits of one industry versus the other, again, that's just a broad concept, right? I'd like to make sure people understand, just because I get on my soapbox and I've been doing this for over a decade doesn't mean it's the best thing in the world. People make money in all sorts of cool and interesting ways, and understanding how to do that, I think, is kind of the core of what you get out of understanding yourself, the mechanisms, psychology that go into that, and making sure that you can navigate that to get to that, whatever your end goal may be.
Exactly. There's no one of the things I think that's come out a couple of times in our conversation today, Alex, is that there's no definitive right or wrong. There are a number of ways of doing things that are more or less suitable. And I think my concern is, the enemy of the perfect is the good. Or the enemy of the good is the perfect, I should say. So don't try to build a perfect portfolio. There's always going to be something that comes your way that you didn't anticipate, that you'd have been better off in hindsight doing something differently. But don't beat yourself up about that. Try to build a portfolio that is good, that thinks about as many possible contingencies: inflation, deflation, recession, growth, different parties in power, different things happening on the trade front, rates going up, rates going down. There are a whole bunch of things that can change and that pretty much always do change. And when one or two of them change in a way that you don't expect, you can be in trouble if you build a portfolio that is predicated entirely on one course of events playing out, and then for whatever reason that course of events doesn't play out. So try to find a way to have some balance and some thoughtfulness as to the variety, the multiplicity of possible outcomes, so that you're not betting the farm on one thesis, no matter how strongly you believe in it, because I'm telling you, no one knows for sure. And markets are highly efficient, and they find ways of, if there's a soft spot, they'll find a way of exploiting that soft spot.
Yeah, absolutely. The term I like is don't let perfection stand in the path of progress.
Yeah, yeah,
That's my household term for that.
yeah.
Yeah, it's really been again great to kind of talk with you about these things that again I think people understand exist, but need to hear someone say. Right, there's a power in speaking this stuff out loud or writing it down. But again, the conversation that we've had today is not. I don't think anyone would listen to this today and think, oh my gosh, that is such like they're like, oh yeah, that makes sense. Like, yeah, I think if I think about it, yeah, I know that exists. But again, having someone kind of say, hey, like this exists, be aware of it. Again, in the back of our mind, we're like, oh yeah, that's probably why it happened. But kind of putting into practice like a preemptive identification of some of these things is a big part of I think kind of what we're getting at here today is that look at this stuff before it happens so that way you're not reacting to it after it happens. And again, there always will be reactionary things that have to happen. You're never, there's a reason that professional baseball players in the Hall of Fame, bat 300, right? It's, there's a reason for that. No one's perfect. And especially at a high level, you have to understand that everything's not going to go right. But, practicing, asking the right questions, making sure, especially if you have a financial advisor, that you're asking questions and understanding that it's a good fit and they're working in your best interest, and also making sure you're working in your own self-best interest. All those things kind of have to go along together. And it's, hard work, getting to a point of retirement or financial stability or whatever your goal is, probably shouldn't be easy. It takes some work, and there's value to be put into that. So again, great conversation today. I really did enjoy getting to talk to someone that, bridges that gap between the traditional world and the alternative world, which I hold near and dear to my heart and my professional heart as well. So again, great talking with you. Really appreciate your time. If people want to learn more or get some more information, I understand you have a book as well. How can they find you and reach out, and where can they find your written materials?
The website is johndegoey.ca, so it's JOHNDEGOEY.ca. I'm based in Toronto, Canada. That might not have been obvious from the interview, but I am. I've written 3 books. They're all listed on the website. I have a podcast of my own, which is called Make Better Wealth Decisions, where I speak to people like you, Alex, talking about a number of things, including alternative investments, which I've done a number of, but also where I talk about investor education, the wealth management industry, how it's evolving. I speak with academics, I speak with journalists, I speak with regulators, people from the media. So it's the same sort of thing where we talk about many of the things that you and I have spoken about today, but maybe from the perspective of making decisions in a conscious way while being aware of our biases. So Make Better Wealth Decisions is the name of my podcast.
Well, fantastic. I do encourage anytime we have a guest that has their own podcast, I encourage my listeners to go out and give it a listen. We sort of do appreciate your time in helping us, produce this. And the most valuable asset that no matter how well we invest can never make any more of is time. So thank you for taking a few minutes out of your morning today to do that. Again, do really appreciate it. With that said, my name's Alex Perny. This is the Alternative Investing Advantage podcast. We appreciate your time today, and we'll see you on the next one.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.